Hello, and welcome to the September market update from Commonwealth Financial Network. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. August was a quiet month. It was a good month. Indices, the stock market was up pretty much across the board here in the U.S. and also abroad. In fact, emerging markets actually did quite well. But it was quiet in the sense that we saw much less bouncing around in the markets than we're used to. Volatility, which is the way that's measured, declined to very low levels, which leads to the question, which is being asked a lot, is volatility too low, and what does that mean? To figure that out, we have to look first of all at why volatility is so low, second of all, as to whether that's likely to continue. So let's start with the why. The big part of the why is, despite the fact that over the past several months we've had really mixed economic data, some good, some bad, the news in August was good pretty much across the board. We saw very strong hiring. We saw a very positive surprise. Consumer confidence rose much more than it was thought it would. We saw consumer spending continue to increase. In other words, the consumer, the engine of the recovery thus far, is continuing to do very well and actually might even do better going forward. On the business side, which has been a weak area, we saw signs of improvement. The dollar continues to moderate. Business confidence continues to be positive. Even the Fed, the notoriously conservative Fed, has come out on a number of occasions and said actually the economy is doing pretty well. So the fundamentals are sound and looking increasingly positive, and that helps create calm in the markets. Even internationally, if you look at, for example, Great Britain, which was expected to collapse after voting to leave the EU, they haven't. If you look at Europe, they're actually growing. If you look at Asia, Japan and China continue to stabilize and even do better than expected. So most of the sources of the worry took a break during August, and that's a good thing. But what does this mean going forward? Well, first of all, the very low levels of worry that we're seeing mean that worry can ratchet up, which suggests that quiet months are typically followed by more volatile months. So we might see more volatility just because of that. Second of all, if you look at what's going to happen in September, it's easy to see where that volatility might come from. The Fed, for example, might raise rates at their September meeting. They're not expected to, so that would be a bit of a surprise. And that could rattle financial markets a bit. The presidential election is almost certain to start rattling financial markets as both candidates go back and forth on what they're going to do to the economy. Even abroad, we might continue to see more bad news. If that's the case, we might see more volatility. But the thing to remember here is the fundamentals are solid. And if indeed we do see some volatility, that's what we need to help make sure it's limited. With that, we will see you next month. I will talk to you then. Thank you for watching.